Hi, thanks for joining me today. Once again, this is Ian Gendler, Director of Research at ValueLine. For those of you who have been following this series of monthly webinars, you will know that I typically provide ValueLine's view of the current state of the economy and stock market. Details from this information then influences the type of data points I use in ValueLine's online screener to zero in on just a few stocks that meet a particular strategy. I then recommend and take a deep dive into one stock that I think investors should buy right now. All previous presentations are available at ValueLine's YouTube channel, and this webinar will be posted in kind within the next 48 hours. For today, however, I'm going to do things a bit differently, and this has been directly influenced by the coronavirus and its impact on the market over the past few days. Just to make sure we're all on the same page, on Monday and Tuesday of this week, the S&P 500 declined roughly 112 points and 98 points, respectively. Over the 2 days, that index lost 6% of its value. Today, right before the presentation, the S&P was down a little further, having given back the gains from earlier today. Of course, the big headline attention-grabbing figures come from the Dow, and that index of 30 blue-chip stocks dropped more than 1,000 points on Monday and 880 yesterday. Needless to say, concerns in regard to the severity and spread of the coronavirus has rattled the market. So, for today, I want to cover the coronavirus in depth, and importantly, its potential impact on the global economy and the stock market going forward. I'm also going to recommend one stock to buy right now that should not be materially impacted from this pandemic. Before I go into more detail, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers, and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. Okay, let's start with some basics in regard to the coronavirus. Coronaviruses are a family of well-known common viruses that cause ailments ranging from the common cold to severe acute respiratory syndrome, or SARS. This is an important detail to note. The current issue involves a new type of virus and has been dubbed 2019 novel coronavirus. The first cases were detected in the city of Wuhan, China, which has a population of more than 11 million people. Symptoms include fever, coughing, and difficulty breathing. Its severity can range from little to no symptoms to severe symptoms and death. However, it should be noted that most deaths, at least so far, have come from vulnerable populations, including the elderly and those with existing medical conditions and weak immune systems. In fact, this coronavirus is thought to be more infectious than SARS and MERS, but less likely to cause death. The infectious part is the big issue here, since the virus is now no longer just in China. Numerous countries, most notably South Korea, Italy, and Iran, are now reporting cases, and it is currently unknown just how serious this is going to become and for how long. According to various news outlets, so far, the virus has inflicted more than 80,000 individuals worldwide and killed approximately 2,700, with the overwhelming majority of cases in China. Just yesterday, the Centers for Disease Control, or CDC, announced that Americans should, and I quote, prepare for the spread of the coronavirus in communities across the country. At this point, the severity of the potential spread is unknown, but clearly this is a serious matter. What is certain is its impact on the global economy. China, where a huge amount of the world's manufacturing takes place, has been dealing with quarantines and, by extension, the closure of factories and manufacturing plants as workers have been ordered to stay home. This will have a huge effect on numerous products across multiple sectors and industries. One example, and they're certainly not alone, is Apple. Management of the iPhone maker has already stated that disruptions stemming from the coronavirus will have a negative impact on its revenues and consequently profits. Other companies, such as Starbucks, and obviously Yum China, which operates KFCs, Pizza Huts, and Taco Bells in China, are experiencing store closures and reduced traffic in those locations that remain open. Needless to say, the airlines and cruise lines are being hit hard due to various travel restrictions. Domestically, things are a bit better. Oh, excuse me, hold on, please. Domestically, things are a bit better for now, but we will still feel the effects. Previously, we expected GDP growth of less than 2% for the current quarter, but growth is likely to come in short of that. Companies are already reducing their near-term financial guidance, and if the virus does indeed spread throughout the nation, we can expect a weak first quarter across the board. We do not think that investors should panic, however. We recommend that you should stay the course, but remain vigilant. This is clearly a fluid situation, and coronavirus news, good or bad, will likely fuel the market's direction over the next days, weeks, and maybe months. So far, I have only mentioned companies that are being hurt by the coronavirus. However, this unfortunate situation has helped others, including video conferencing enterprise Zoom Technologies and Clorox, to name just a couple. One stock that we are particularly bullish on, and have been for some time, is Home Depot, ticker HD. The home improvement behemoth is today's one stock to buy right now. Followers of this webinar series may recall that I recommended Home Depot about a year ago. In fact, it was the webinar that was held on January 30th, 2019. At that time, the stock was priced at around $177. Investors who followed that recommendation have achieved a total return of about 40% in 13 months. However, we do not think shareholders should sell. On the contrary, HD appears to have plenty more room to run. I'm now going to sign in to ValueLine.com and provide specific information about Home Depot. Importantly, the company just yesterday reported healthy fiscal fourth quarter financial results. This is a good time to mention that in addition to our ubiquitous one-page stock reports and various investor tools and model portfolios, a subscription to the digital edition of our flagship service, the Value Line Investment Survey, entitles users to our supplementary reports, which are written and published by our analysts when important news breaks. In fact, on most days, we publish a number of such reports, and we don't just report the news. We analyze it and inform our subscribers of what it means for the underlying stock. From the dashboard quick links, I can quickly and easily access the supplementary reports. As you can see, just today, we have already published a number of these. Yesterday, we reported on Home Depot, and let's take a look at that information now. As mentioned, Home Depot reported quarterly results, and Associate Research Director Matthew Spencer had the following to say. Shares of the Home Depot moved higher after the world's largest home improvement retailer announced better than expected fiscal fourth quarter results. The top line came in at $25.8 billion in the final stanza of fiscal 2019, marginally ahead of our $25.7 billion forecast. The figure was down slightly from the year earlier tally, though this was due to an extra week of sales in that period. More importantly, comparable store sales climbed 5.2% overall and 5.3% in the United States. The retailer benefited from a healthy consumer and tailwinds from a generally strong housing/remodeling market. Its holiday events also resonated well with shoppers. All geographies saw positive comps, and strength was broad-based across product categories, professionals, and do-it-yourself customers. Sales of large ticket items were also strong, and lumber price deflation had less of an impact in the January term than it did in the first three quarters. All told, while transactions declined as expected, the average ticket rose 4.1% in the January term, and sales per square foot advanced 2.8%. The strong sales performance helped to deliver earnings that were well ahead of our call and guidance. Although the gross margin narrowed by 20 basis points and SG&A expenses increased, the bottom line clocked in at $2.28 a share versus our $2.08 estimate. This figure was 3 cents above the year earlier tally, aided by a lower share count and a favorable tax rate. For the whole of fiscal 2019, the Home Depot earned $10.25 a share on sales of $110 billion. Looking ahead, our outlook for Home Depot remains positive. The U.S. economy should continue to provide a favorable backdrop for the Home Depot to operate against. Indeed, unemployment is low, the housing market is generally strong, borrowing costs are low, and consumers will likely continue to show a willingness to invest in repair and remodeling projects. Management reiterated its guidance of 3.5% to 4% growth in both sales and comps this fiscal year. In regard to the coronavirus, Home Depot appears to be rather well insulated. It derives more than 90% of its sales from within the United States. 30% of its product offerings are manufactured abroad, including in China, but management recently stated that most of its short-term inventory needs have already been delivered or are on their way. What's more, many of its best-selling brands and products are manufactured in the United States, and its lumber is sourced in North America. Now let's take a minute and go to Value Line's digital report for Home Depot. I'm going to head back to the dashboard. Right at the top, you will notice that HD garners our top rank for safety, 1, and highest score for financial strength, A++. These proprietary Value Line metrics suggest that the company can weather problems well. Historically, stocks ranked 1 for safety have held up far better than the broader market during corrections and downturns. A quick look at the valuation module shows our estimates for 2020 and how they compare to previous years. As you can see, we expect healthy annual increases for sales, cash flow, earnings, and dividends. I'd also like to point out that within the next couple weeks, we will be publishing a brand new full-page report on Home Depot, which will include our thoughts for 2021. As for the stock, going back to Mr. Spencer's supplementary report, we continue to like it for conservative investors looking for exposure to the housing market. HD shares offer an above-average dividend yield, which was enhanced by the announcement of a 10% increase in the quarterly cash distribution to $1.50 a share. As mentioned, it also has several defensive attributes, including against the coronavirus. All told, Home Depot, ticker HD, is today's one stock to buy right now. Give me a moment, and I will now tackle your questions. All right. The first question is, what do you think of airline stocks at this time? To be honest, I would avoid that industry currently. That and the cruise lines, they're just too heavily dependent on travel. Even if you have an airline that doesn't do a lot of international travel, people are scared. It's not a coincidence that Zoom Technologies, which does meetings over the internet, that stock has done well. All right, moving to another question. What is a better investment? To hold 3 or 4 stocks like Boeing, Northrop Grumman, etc., or an ETF that holds all of the major players? It really depends on your goals and risk tolerances. Obviously, if you just own a small number of stocks, especially all in the same industry, you have some diversification risk there and company risk. For instance, if you just owned Boeing and Northrop Grumman, Northrop has done quite well, but Boeing has been a serious underperformer over the past year. So if you were interested in the aerospace defense space, for most investors, I'd probably recommend an ETF. Can you explain why the PE ratio of some companies are extremely high? The companies that I'm referring to have been around for years, and based on their financials, seem to be doing okay. Experienced a huge run. So PEs were very high as the stock prices were moving up faster than earnings. Before Monday, I would say the majority of stocks we cover were trading at PEs that were far beyond their 10-year average, for instance. So it's really just a result of a rising market. Remember, it's been, like I said before, this mini correction, we've had pretty much a 10-year run of gains. All right, next question. What is your view of Disney? So Disney was a stock I considered highlighting today. It has declined in value recently. It's down on their CEO leaving, which was just announced last night. And I think it is a very good holding. However, I didn't want to highlight it today because, remember, they own theme parks and cruise lines. And those will be impacted, perhaps in the short term, by this coronavirus. Otherwise, I am bullish on Disney. I think if you're willing to hold it for a long time, now might be a good time to get in, but they may be impacted by this coronavirus. They probably will be. Back to Home Depot, where is the current price relative to the value line? That actually is going to be updated in 2 weeks with the new report. I can tell you, though, that Home Depot has done incredibly well. It is a stock that is trading at an elevated multiple, so it is likely above the value line, but I think that's justified in this case. You mentioned Clorox, HD, and one more. What was the third one? That was Zoom Technologies, the video conferencing company. The ticker is ZM. What about your feelings about Lowe's? Also positive on Lowe's. And personally, I prefer Home Depot. How does Value Line calculate a fair value price? Is Home Depot overpriced now? So we don't use a fair price. We don't use that metric, but we have several proprietary measures that provide our subscribers with actionable items. For instance, our timeliness ranks show how we think the stock is going to perform over the next 6 to 12 months. We have an 18-month target price range and 3 to 5 year projected range. So we can go back to the digital report, and I can just highlight that quickly. So first of all, Home Depot is right now is $235 and change. Our 18-month range is $186 to $292. This gets updated every week. And our 3 to 5 year range is $235 to $285. So, for instance, looking at this, the stock's already trading at the low end of our range, but we still think it can have a little bit more room to run. Obviously, picking a big blue chip company, this is not an aggressive growth story, but I think Home Depot will outperform the market, especially as further coronavirus fears take hold, if that were to occur. Did you use any kind of screener to find your Home Depot recommendation? In basically all of my previous webinars in this series, I have, but I found Home Depot after discussing it with several of my analysts. This is a little bit of a different webinar where I didn't utilize the screener. The last question about which biotech companies might benefit from coronavirus. I recommend coming back to our website on Monday. We will have brand new reports on all the stocks in the biotechnology industry. What's your thoughts regarding XOM since the last Value Line update? We just put out a new report on ExxonMobil. It was new on our site this past Monday. All right, there's a lot of questions about individual stocks, and I can't, unfortunately, comment on them. I don't cover Emerson Electric. I recommend checking out our reports, going to our website. All right, can you talk about the timeliness rank for Home Depot? Sure. So as you can tell, it is ranked 3 for timeliness, which is neutral, or we think it will mirror the year-ahead market according to this ranking. However, as I mentioned, with the coronavirus fears, I think Home Depot has a good chance, this is my opinion, that it will outperform the market over the near term. Are some of these stocks with high prices ever going to split? Maybe not. Splits used to be very common. Stock would get to $80, $100 and split. Now it is no longer a priority for companies. It used to be to split to get round lots, and they catered to more of the individual investor. Now it's mostly institutional trading and quant trading, and it doesn't matter what the stock price is. So if you're an investor chasing splits or interested in splits, I don't think you're going to have that many to choose from over the years ahead. All right, that seems to be all of the questions. Thank you so much for joining me today. Be safe, and hopefully this coronavirus isn't too serious. Take care.